Venture capital investing is all about timing. The stage at which an investor enters a startup can determine the level of risk, the potential for returns, and the extent of their involvement. Some funds specialize in early stage bets, where the risks are high but so is the potential upside. Others prefer to back later stage companies, those that have already demonstrated success and are now seeking to scale massively. Venture capital firms don't just differ in the industries they invest in, they also vary in how they structure their funds across different startup stages. Some funds specialize in a single stage, focusing all their resources on either early, growth, or late-stage startups. Others take a multi-stage approach, investing across the entire startup lifecycle. Both strategies come with distinct advantages and risks, shaping how funds deploy capital, interact with startups, and generate returns. Understanding these differences is crucial for both investors and founders seeking the right funding partners. At every stage, the size of the investment or ticket size varies based on the company's maturity, valuation, and the investor's strategy. Understanding these different stages and how investors evaluate startups at each point is crucial for making informed decisions. At the very beginning of a startup's journey is the pre-seed stage. This is the moment when an idea is just taking shape, often in the hands of a single founder or a small team. There is no product, no revenue, and no customers, just a vision and perhaps a rough prototype. Funding at this stage is typically used to develop an early version of the product, conduct market research, and build an initial team. Investments tend to be relatively small, ranging from $50,000 to $500,000, often coming from angel investors, friends and family, or specialized micro-VCs. Some well-known accelerators, such as Y Combinator, also provide early backing in exchange for equity. Investors at this stage focus on the strength of the founding team, the potential size of the market, and whether the idea is technically feasible. It was at this point that Airbnb's founders secured a modest $20,000 from Y Combinator to start building their platform. Once a startup moves past the conceptual phase and develops a prototype or a minimum viable product, the MVP, it enters the seed stage. At this point, there may be some early signs of traction, perhaps a few pilot customers, beta testers, or a small but growing user base. The focus now shifts to refining the product, hiring key personnel, and testing go-to-market strategies. Seed investments generally range from $500,000 to $3 million, provided by seed-stage venture funds, angel investors, and investment syndicates. Investors seek evidence of customer validation, engagement, and early signals of product-market fit. For example, Uber raised $200,000 in its seed round, allowing the company to launch its beta service in San Francisco. If a startup proves its concept and gains early market validation, it progresses to the Series A stage. By now, there is a functional product, revenue generation has begun, and the business model is being refined. This stage is all about scaling operations, expanding the customer base, and solidifying a competitive advantage. Venture capital firms leading Series A rounds typically invest between $3 million and $15 million, aiming for ownership stakes between 15% and 25%. At this point, startups often have annual recurring revenues, or ARR, between $1 million and $5 million. Investors look closely at revenue growth, unit economics, such as customer acquisition cost, or CAC, relative to lifetime value, or LTV, and scalability. Slack, for instance, secured $42 million in its Series A round as its workplace messaging tool gained traction among businesses. With a solid foundation established, a startup that successfully navigates Series A moves into Series B. By now, product-market fit is well established, and the company is focused on aggressive expansion. This is when startups use capital to enter new markets, grow their sales teams, and diversify their product offerings. The ticket size in a Series B round typically ranges from $15 million to $50 million, with larger venture firms or growth equity funds stepping in. Companies at this stage often have ARR between $5 million and $20 million, and investors begin assessing market leadership and operational efficiency. Spotify, for example, raised $100 million in its Series B round to expand internationally and secure critical licensing deals with major record labels. Beyond Series B, Startups enter the late-stage investment phase, which includes Series C and beyond. At this stage, companies are generating substantial revenue and shifting their focus toward market dominance, strategic acquisitions, and eventually an exit, whether through an IPO or acquisition. These rounds involve significant capital injections, often between $50 million and $500 million, and are led by late-stage venture firms, private equity funds, or even sovereign wealth funds. Investors now prioritize profitability, IPO readiness, and market consolidation strategies. Airbnb's $450 million Series C round, for example, set the stage for its eventual public offering, allowing the company to expand globally and solidify its position in the market. Understanding the evolution of startup funding, from the initial spark of an idea to global market dominance, helps both founders and investors make strategic decisions. Each stage presents its own challenges and opportunities, and the timing of an investment can be just as critical as the amount committed. Venture capital is structured around startup stages, with different risk profiles, return expectations, and ticket sizes at each level. Early-stage funds, pre-seed and seed, invest small amounts in high-risk ventures with potential for outsized returns. Later-stage funds, Series B onward, back companies with proven traction, focusing on scale, efficiency, and exit strategy. Investors vary between stage specialists and multi-stage players, shaping their involvement and returns.